hungry and with an insatiable appetite for funds. India's armed forces have a series of solid takeaways from Budget 2022. Finance Minister Sitharaman, who has held the defence portfolio in the past, has made one thing clear. This year's defence budget is all about boosting self-reliant India. For starters, India's capital budget, the funds used on modernising the forces, are up 12% from 1.35 lakh crore last year to 1.52 lakh crore this year. Now remember those figures as we dive into the first big announcement. 68% of India's weapons modernization budget will be reserved for domestic industry. That's approximately 1 lakh crore rupees, unprecedented in India's patchy procurement history. The announcement makes it clear that Indian-made weapons and military hardware will be given priority over imports. As India Today has already reported, several pipeline deals for foreign helicopters, missiles and other hardware have already been scrapped in view of the new Atmanirbhar push. Now the second big announcement. 25% of India's defence research and development budget will now be earmarked for private industry, startups and academia. If implemented well, it could be the beginning of a truly robust defence industrial complex with a focus on exports from India.
We at the Society of Indian Defence Manufacturers welcome all the three major announcements made in today's budget. It will give visibility to Indian companies to plan their investments and capacity to address future requirements coming from our defence forces. It will help in unleashing innovation and creativity in all segments of Indian ecosystem.
Long struggling for a level playing field, the twin announcements provide a huge push towards a homegrown defence industry. From missiles to fighter aircraft, to submarines and warships, to firearms and rifles. The Prime Minister's dream of Atmanirbhar Bharat in defence could just be off to its first real start. Bureau Report, India Today. Millions of Indians invest in them. Billions of dollars have been parked in them. Yet cryptocurrencies had no legal standing in India until now.
For the taxation of virtual digital assets, I propose to provide that any income from transfer of any virtual digital asset shall be taxed at the rate of 30%, 30%.
This announcement by the Union Finance Minister has changed the game. For investors and market players waiting in the wings for months for certainty whether their crypto investments are legal, whether their gains will be taxed, whether their losses can be set off against other assets, the fog has lifted a little. Under the budget proposals, gains on cryptocurrency and NFT transactions will be taxed at a flat 30%. There will be no difference between short-term or long-term investments. No expenses other than the cost of acquisition are deductible. No losses in other asset categories can be set off against the gains here. A TDS of 1% will be introduced to track all transactions, and gift of crypto assets will be taxable in the hands of the recipient.
We have circulated a paper. Inputs are coming in. Public stakeholders are also talking about it. So regulation goes through that process. I don't wait till regulation comes into place for taxing people who are earning profits, can I?
Market players have mixed reactions on the tax move.
The biggest highlight of today is the clarity in whether crypto is legal or illegal, right? So it just, with taxing crypto just makes it legal. India being the talent hub for tech, and not just tech, in fact, a lot of other skills as well, gets the opportunity to be part of this and gets the opportunity to start building for this. That means a lot more job opportunity for India.
If you put such high taxes on crypto, it's definitely gonna dampen the trading activity. My worry is that if you put such high tax rate, it might also be counterproductive in some sense. I mean, people will have incentives to figure out some other ways to do trading because, honestly, 30% is a lot higher, and especially more than that, the 1% TDS, that's also not very productive to the entire industry.
Meanwhile, the taxation rate on cryptos puts them on par with game shows and lotteries, much higher than the capital gains charged on assets like equities and real estate. Bureau Report, Business Today Television.
A power-packed panel with us to discuss some of the major themes in this year's budget. Subhash Chandra Garg, former Finance Secretary, Ashok Wadhwa, Group CEO, Ambit, Saurabh Mukherjee, founder and CIO, Marcellus Investment Managers, Nainalal Kidwai, Chairman, Advent Private Equity and past President, FICCI, HP Ranina, corporate lawyer. Some wonderfully powerful voices tonight to take us through the contours of this budget speech. It was tight, it was well packaged, but was it a lot of gloss or was there genuine meat in this budget? What were your key takeaways? Ashok, let me start off with you.
I think in balance, it's a decent budget given the war between politics and economics. You know, we have 5 major elections coming through. I think the finance minister has not fallen to the temptation of populist measures. No new taxes were levied. There was a lot of talk about inheritance tax and a lot of talks about wealth tax, gift tax. Yeah. No such temptation has been kind of, has attracted the finance minister to impose new taxes. There is disappointment that, the lowest marginal tax rate has not moved up. 2015, 250,000, just by inflation, it should have been up to 4 or 5 lakhs. Perhaps would have also created a little more free cash flows for the lowest part of our economy, and they would have been able to spurred some consumption, which is so necessary at that level. But I would say overall, it's been a fair budget. Obviously, the icing on the cake is the expanded expenditure on infrastructure. Government realizes the acute need to create jobs and has chosen the pillar of infrastructure to lead it, hoping that the private sector will be further motivated to now participate in this whole growth cycle. Adequate amount of focus on manufacturing. I think India's second and perhaps the only chance to now take advantage of the China plus supply chain that everybody wants to follow, extending that 15% scheme for manufacturing by another year. Some focus on startups which have brought in so much capital to the country. But again, 1 or 2 things have been missed out over there, in particular taxing of ESOPs and not being able to equate tax on unlisted and listed, even if you keep a difference in the period of holding. So I would say overall decent budget given the circumstances, the fact that we are coming out of COVID and have had a tough time.
All right. Let's also bring in Dinesh Kanabar. Ashok, thanks so much for your time this evening. Great to get a perspective from you and reassuring that you feel things are on track. Markets clearly also responded well to the budget and its agenda for growth. Dinesh, take us through, in terms of how you feel this impacting industry and private investments as well. With the thrust on capex, there is an expectation that the private sector will also contribute. Several key announcements have already come in from some of the major players over the last few months. Do you see this momentum continuing?
The answer would be absolutely yes, and let me tell you why. So first of all, the outlay on capex and the outlay on infrastructure spend, which is up by 35%, is in some sense unprecedented, and that will create its own impact, own ripple effect. And this has been backed up by 2 things. So first is we have had a series of PLI schemes, 14 PLI schemes which were introduced recently. One more is being introduced, as was announced in the budget, 18,000 crores approximately set aside for solar energy. So again, a manufacturer in India gets an impetus. And then there was this 50% rate of tax for the new manufacturing companies, which had to commence before March 23. People had lost out on time because of COVID, and that has been extended to March 24. So overall, if you look at all the measures, be it in terms of PLI schemes, be it in terms of whatever else, all is unidirectional. We are then told about the fact that you are going to sort of introduce a new SEZ scheme, and I think that's very, very relevant because to make the PLI successful, if to have an SEZ which goes hand in hand and relooked at which of course we don't know what will be the new contours. But if that is implemented well, all of which will go very well towards Make in India.
All right. Nainalal Kidwai, coming to you, the criticism, if I may call it that, is that consumption doesn't seem to have witnessed a major support. What's your own reading of the fine print so far? Because there are concerns that the second half of the next financial year could see a dip in the overall economic growth.
So I think the expectation, hope was that money would go directly into the hands of middle class, rural poor, with a view to bringing on consumption. But consumption also comes from job creation, because with jobs, people have money to spend. The whole issue really is going to be how quickly we can ensure this job creation and therefore pump start the economy with the consumption side of the equation. And I think there are opportunities, the public services programs like the Swachh Bharat Mission, etc., big job creators. NREGA, big job creator at the rural level, putting money in the hands of rural poor. Mind you, the NREGA figure is down 25%, but at least there is money to be spent there. So could we have seen more? Yes. Is it ignored? No, because there are these programs which are built towards job creation. And the Prime Minister himself talked about green jobs, and he's right. I mean, the whole opportunity, whether it's for the solar PLI or indeed the focus towards greening the economy, means there will be investment in those areas. That was really more like a vision statement. But indeed, as we look at focus in these new age, new areas, many of them are highly labor intensive and can give us an opportunity to ensure that through job creation, we push for consumption increase. I just want to come in on one announcement which should not be ignored, and that is on the sovereign green bonds. India has never issued a sovereign bond, and the world over people issue bonds. Sovereign wealth funds exist, sovereign bonds are issued.
Right.
This is a first for the country, and what a wonderful way to open that ledger with the green bond. And the mix of then using green bonds into green infrastructure, because you can only spend in green spaces, is a great way to take the funding forward for our infrastructure projects.
Nainalal Kidwai, that was a good point, and for the first time a budget speech, if not the document, has spoken about a target for job creation, and I think that by itself, even if just a statement of intent, is a very, very significant one. We have Udyan Mukherjee back with us now. Udyan, welcome back and take it from here.
Thank you, Siddharth. I want to get Saurav Mukherjee into the discussion. Saurav, you've been hearing in. I want your preliminary thoughts on what the stock market would take away from the budget today, and also the bond market, because the stock market reacted well, the bond market not so well, because yields hardened, and there was quite a bit of consternation about whether this budget is inflationary and whether the very large borrowing program of the government actually means bad things for this year. How would you see both these reactions in conjunction, the stock and the bond?
I think the stock market was relieved. I think with the heavy election calendar, there was anticipation, there was trepidation that there will be taxes on the rich, there will be CGT hikes and so on. And in that context, I think we were all very, very relieved that it wasn't an anti-rich budget. By and large, the long-term CGT soft signals, especially on startups, were quite positive. I think the other reason the market was relieved was there wasn't a plethora of pro-poor spending, the sort of RevX that you expect going into elections like Uttar Pradesh. So it was a very mature budget in that regard. I think the bond market will realize, I think the bond market is a little disappointed about the 6.4% target. The fiscal mathematics is quite conservative. My reckoning is the FM is being quite canny about that disinvestment figure of 65,000 crores for next year. She's deliberately not committing to a large number, because if she does, that boxes her into a corner. I think in due course, the bond market will realize that there is nothing particularly fiscally disastrous about this budget. If anything, by promising a capex number, 35% growth, which I think will be very, very difficult to deliver, I'll be astonished if they can grow capex by 35%, and they've throttled off RevX. I think it's actually a fiscally very conservative budget.
Right. Rajiv, we were speaking earlier about the kind of job creation that this kind of infrastructure spending might lead to. But I also want you to come in on this crowding in of private investment because, a lot of us hope that we are at the cusp of a good private capex cycle of many years, of the kind that we have not seen for many years in our economy. But now the finance minister says that her focus on capex and the infrastructure projects that she's announcing will crowd in private investment. Do you agree with that assessment, or do you think private capex needs some other things like capacity utilization going up, like a good earning cycle for a few quarters, and those are the things which actually get the capex cycle moving in the private sector rather than efforts from the government to crowd it in?
So there are at least three different factors that will crowd in private investment. Infrastructure investment will do this indirectly by first creating jobs, then creating demand, consumption demand. That will increase capacity utilization, and that will incentivize industry to expand investment. That's the first mechanism. Second mechanism, which is in the budget, is actually a very muscular industrial policy. This is quite a novelty for India, and this administration has been building on this idea for the last couple of years through these production-linked incentives. So all the money that is going to go into the defense sector, into electronics, into semiconductors, all of this is going to be very important incentive for industry to expand their own investments. That's the second mechanism. And then the third mechanism is really a return of trust and confidence. So as these two engines begin to fire, the economy retains its momentum. Hopefully we have a good agricultural season. I think trust and confidence in the private sector will increase, and that itself will initiate greater private investment. So I really believe that under the circumstances, this is quite an intelligent budget. It is a very sensible budget, and it has outlined a strategy for sustainable growth. Everything now depends on execution, and I think the balance of probability is that it will succeed. At least as an optimist, that's what I believe.
Okay, Rajiv, thank you very much for that assessment. And I want to get Saurav's view on this because Mr. H.P. Ranina, noted tax expert, is waiting to tell us what it means for individual taxpayers, given that there was no tinkering with tax slabs. But Mr. Ranina, just hold for a second because I want Saurav's view on this capex business. Saurav, all of us dream of a great capex cycle for 3 years. Are we at the cusp of one? And do you think what happened in today's budget with the capex outlays nudges us closer, or do you think the two are unconnected?
I think today's capex announcement is not going to hurt, provided the government can deliver on this sort of 35% surge, which as I said, I think the delivery on the ground level is questionable. But if you look at it, steel companies are announcing capex. The auto sector is announcing more modest amounts of capex because they've got their other problems to contend with. I've seen some of the FMCG companies announce a bit of capex. I don't think we're going to get the old style 2005 to 10 capex. That was a very different era for India. The country doesn't need that sort of heavy power plant construction again. But it does look likely that we will see GDP capex growth getting to say the double-digit numbers that we yearn to see. I don't think we'll get the 17-18% growth that we saw in that 2005 to 11 era. I'm not even sure that was desirable because a lot of that was just money pushed down the drain. But double-digit capex does look to be feasible over the next 12 months. If the government fires, the steel companies pick up the slack, and then the real estate sector comes in as well.
Right. Mr. Ranina, there was not too much tinkering in terms of income tax slabs, but there was a provision to update your filing if you had made errors. What was there? I mean, what did you take away from an individual income taxpayer's perspective from this budget? Anything good at all?
continuation of our
Mr. Ranina?
previous budget. Yes, can you hear me? Hello?
Yeah, I can. Go ahead.
So there's nothing done at all for individuals, except that they're given you an opportunity, a window to file a tax return in case you have made an error, and you can do so within a period of 2 years. But that has a caveat to it, that you will have to pay an additional tax of 15% if you do it within 12 months of the end of the assessment year, and the additional tax of 25% if you do it within 24 months from the end of the assessment year. So this is a new provision which has been introduced. The purpose is to reduce the litigation, because in the past the government had to reopen the assessments under Section 147, and that led to a lot of litigation. Now under Section 147, they have made one more amendment, which you find when you read the details of the finance bill, which is that if there's a tax audit objection, then that could be a ground for reopening assessment, which could not be done earlier, because many high courts and Supreme Court had taken a view that a tax audit objection does not amount to any additional information being available to the tax department. So now they've brought in a law to say that even if there's a tax audit objection, then they can reopen an assessment within the prescribed period.
Right.
They have also made a few other amendments, like saying that if you have got a cash credit, then the creditor has to prove the source from which he has got the funds to give you the cash credit. So you find that there's a tightening of the tax laws, especially as far as tax evasion is concerned. And there are other provisions made for charitable
Mr. Ranina,
which again...
Sure. We'll have to leave it there because we are running a little short of time. Thank you very much for your time today, and indeed Saurav for yours, because we've got Deepak Parekh, Chairman of HDFC, also joining in now. Deepak, thank you very much for joining in. I want to start by asking you of what you've made of these capex proposals and all this debate which has been happening since morning about the government's thrust on infrastructure investment versus stimulating consumption, addressing the supply side versus the demand side, which a lot of people thought the emphasis would lie in. How have you taken it?
No, I think the spend on roads and railways and logistics and infrastructure of 7.5 crores is a very good suggestion, because we want investment to happen. And as you know, the private sector is delaying investment because the capacity utilization has not reached the level that it should reach. So government spending has to be done. And this will really boost the economy because it's employment generation, and number of raw materials like steel, cement, building materials, and lots of others are used in construction. So I think it's a good. My only concern is we must ensure that implementation and execution is the key now. Do we have the wherewithal to execute these projects? And we have to be careful, because there are very few contractors who have the capacity to build this much. Most of the contractors who were there 10 years ago have sort of disappeared or are struggling in their present position. So we need 5 Larsen & Toubros. Right. We don't have 5 Larsen & Toubros. We have 1 Larsen & Toubro. So we have to ensure that execution should not be the weakness. I think the resources will be there. The intention of the government is extremely good, and it will be employment generation. Now, the other point you made is very true. Most FMCG companies and consumer-related companies are saying that the household demand has slowed down. And household demand can only increase if you give more money to them. If they have more spending money, for which they have to do something regarding ATC or tax slabs, which they have not done. But my logic here then is that, if it ain't leaking, don't change it. The proof of the pudding is that the government gross tax revenues have gone up by 50% in the first 8 months. And this includes corporate tax, this includes income tax and central GST. So the tax rates are reasonably low, and the government is getting increased compliance and increase in revenue. So why do some minor changes here and there? I was only hoping and a little disappointed that ATC, which is a deduction for savings, pension, insurance, and interest on housing loans, that limit has not changed for years. I think 6-7 years. While house prices have gone up, the compulsion to save has gone up with the health issues. Health insurance has become a necessity. So I think there I was a bit disappointed that they did not increase the ATC limit. But otherwise, I think overall, given the constraints she was working on, about third consecutive year of the budget where we had the impact of COVID-19, interest rates are going up globally, the loosening credit policy, the loosening monetary policy is behind us, yields are rising, and number of commodity markets are all-time high, crude has gone up to $90. So these are constraints of the government, of the finance minister. So in a way, her hands are tied. Despite that, I think she did a very credible job trying to push infrastructure and trying to push capital spending.
Well, let me ask you then about this point that you've raised right now about her fiscal management. Because, this year it was pegged at 6.8, it has come in at 6.9, and next year she's at 6.4. But this on the backdrop of very bountiful tax revenues. I mean, we're 17.5% nominal GDP growth, net tax collections running way ahead of earlier estimates. And the government gross borrowing program for next year is a very, very large number, which has sent the bond deals skyrocketing today. I mean, at HDFC, you follow bond deals very closely. Are you a little cagey or cautious about the bond market's reaction and whether the government should or could have done more on the fiscal deficit front in getting back on the path of prudence?
You see, these are exceptional years because of the pandemic. All over the world, most countries have got this massive fiscal deficits, and you have to be accommodative in these circumstances. And so, with a 9.2% GDP growth rate and an 8.5% for next year, I think we can stomach a 6.4% fiscal deficit. And if we had no growth, then it would be disaster. But since the growth is there, I think it's manageable, and very little choice the FM had to do anything more about it.
What is the way forward with interest rates this year, Deepak? I mean, how do you see it? Because you know that in the US, interest rates are going up. Here, bond deals have hardened today, and it looks like inflation is beginning to look like a bigger problem than it seemed at first. Is this a year where we'll struggle on the monetary policy front, you think?
No, I think inflation is entrenched, which impacts the common man. The CPI inflation number is 5.6 or 5.4%. And yes, this will be a year when global interest rates will go up. And even the Fed has said, someone has said the Fed will increase rates 5 times this year. So we will have to increase lending rates. We will have to increase deposit rates. And I don't think it's going to go significantly out of hand, but maybe 1% here or 1% there by the end of the year, you will see. Not significantly high. We've seen interest rates of 13, 14%. We are not talking about these rates. We are talking of maybe 0.5% higher this year.
Okay. Since you follow all these issues very closely, let me ask you about the digital rupee as well. What did you make of that announcement, and what shape and form do you see it taking, Deepak?
Yeah, I would say that I was surprised to hear that announcement. You know, Finance Minister's budget had a lot of technology and digitization in the state governments, in PSU, and pushing that. And so it was an extension of that let's talk of a digital currency. And I think we'll have to wait for the Reserve Bank, how they manage to do it and what their plans are. I'm a little unsure how will it work. So I don't want to make any guesses to that. But let's see. We'll have to wait and see. But it is a forward step because it's going in the right direction. And you will see digital currencies. You will see digital rupees as the time goes on. Maybe we are accelerating this jump or this step, and we'll have to see how to manage it.
You were just telling me about how constrained the finance minister is, which in terms of revenues has been a difficult year despite good tax collections. Now, given that, one would have expected that she would have put the pedal down hard on disinvestment, on asset monetization. These are established plans, but we saw 65,000 crore, very, very tepid target for next year. We heard nothing on the asset monetization plan. Are you surprised or disappointed that the government is going so easy on capital receipts or finding resources to raise capital to put more at work on the capex front?
Well, she did say that we managed to do Air India and the steel company, Nilachal Steel, today. And we will do the LIC IPO this year, which is March. And so if she's able to do that, I think it'll be very useful for the government to get that extra money from the LIC IPO. So I agree. I was a bit disappointed. She was absolutely quiet about asset monetization, or the public sector banks have not done well on the market because she didn't say anything about merging public sector banks and what her plans are. But it is, and the target this year, the target was 1,75,000 crores, and you hardly scratch the surface so far, unless you do the LIC divestment. So I guess since the results have not been visible during this year, she didn't want to talk about it until she shows that she's able to monetize certain assets. Yes, it was a bit disappointment, but I think you will see her. You will see a greater emphasis by the government and a push to monetize more of government assets and disinvestment also.
You know about these things, Deepak. I want to ask you to say candidly, what do you think is going on with this process? Because, last year hopes were raised because she said we will experiment with 2 public sector banks first. That never happened. There was no noise about it. And this year we are down to 65,000 crores. BPCL is still dragging its feet. Is it union resistance? Is it the fact that the wrong kind of businesses are being brought to the market? What do you think is the issue out there? Why are we not able to push ahead with this?
I think the biggest concern the government is having is accusation from opposition that you've sold it at a low price. Because price discovery is not that easy in unlisted companies or in assets that are not listed. But she mentioned BPCL and Shipping Corporation should IDBI Bank. These 3 are listed companies, and you will see some progress of these 3 companies in the coming year. I'm quite convinced of that. Now, bank mergers have been stalled because the existing mergers that have taken place, I don't know how well they have worked. And, because it takes time for integration of management, integration of the union. So probably it is work in process. And but land assets with the government, the railways, the defense, they have massive amount of land all over the country. That has to be monetized. And liquidity is there in the market to fund these. Because, housing and commercial real estate has really taken off well in the last year or so. So there is an opportunity for government to sell surplus land and monetize land. But I don't think they've been able to do that. Again, not because of union issues, but more because of, selling it at a throwaway price and, selling government silver at a throwaway price. So this is their concern. How do you come to a decent valuation which is acceptable by the opposition, by everyone, that this is a decent price to sell an asset which is not listed? So I think the first step they will do is try and sell the listed companies like Shipping Corporation and IDBI Bank, as I said, BPCL, which are all listed.
How do you see the banking system this year, Deepak, in the light of this budget? Do you think that a new credit cycle is on its way? Because so far we haven't seen a major pickup in credit. And there is one fear among many quarters that because incomes have been hit so badly at the lower end of the pyramid, you could actually see the start of delinquencies happening at the retail level. Now, given the perch that you observe these things from, do you think there is a real threat of that? Or do you think this is an overblown fear?
No, there has been, massive deleveraging by the corporate sector. And that's one of the reasons why the credit growth is muted and is tepid. Because many companies have, because of good cash flows and because of capital expansion plans are not yet finalized or capacity utilization has not yet reached, deleveraging of corporates have taken place in a massive way. And the other issue is many AAA, AA companies have been able to raise money from international markets, from the bond markets. Even junk bond companies with very low credit rating have been able to mobilize resources. And since they were so economic, overseas money was so reasonably priced, many companies have taken a step to borrow internationally. So yes, there has been a disappointment on credit offtake by all public sector, private sector banks. The retail credit has grown significantly. And the retail credit has grown both consumer credit, personal loans, and mortgage loans. The mortgage loans growth has been phenomenal this year, despite COVID, despite lockdown. And the unsold inventory has shrunk, which the developers were carrying over the last 2 years, where we said that there's a massive problem of unsold inventory. So that numbers have come down, and we see an uptake from our loan applications. The loan applications have shot through during this year. And so retail loans have taken off, corporate loans, deleveraging has happened. So it appears that there is no growth in corporate offtake.
Right. My last question to you, Deepak, before I let you go. You referred to the bond market. Given that the government's issuance is going to be very large this time around and there is already upward pressure on yields, do you think the government missed a trick by not doing the short-term capital gains tax waiver on bonds, which would have led to the inclusion of India in the global bond indices? There was an expectation in many quarters that it would happen this time around. Are you disappointed that it did not happen? It did not come through?
No, if Indian bonds are included in the global index, there's a number which is bandied around that India will get $25 billion inflow into the country. Now we have to make that happen. And I personally feel they will do something during the year relating to the GIFT City. And, the GIFT City has got a huge impetus on education and other items. So I'm sure they'll do something on the global bond, how to make Indian bonds as part. I must also say, Udayan, that although we've seen a $3 billion sell-off in January of foreign portfolio investors, many investors, as we have a large foreign holding, almost over 70% in HDFC, many foreign shareholders who are our shareholders are saying that it's about time India is included in the global index. Today, India gets money from emerging market funds and from Asia funds. But we are not yet a part of the global markets, equity markets. So global equity funds will have to have 1%, 2%, 5% in Indian equity markets, which will give a fillip to our equity markets. And this is going to happen sooner than we think. Because, Chinese companies which were part of global index and people were buying in global funds, Chinese stocks, they have been disappointed with that. And with the liquidity and with good systems of entry and exit in listed investments, I'm sure this is going to happen faster than we all think.
Okay, Deepak, thank you very much for your time. Pleasure talking to you as always. Thanks for joining in today. Thanks. Let me turn to Naina Lal Kidwai immediately to get her response on what Deepak Parekh has been telling us. Naina, as peers, you and Deepak were contemporaries in a sense. Give me your thoughts on what you made of what he was saying about how India negotiates the higher inflation, higher interest rate regime that we are about to get into globally and probably in India after so many years. How do you see us negotiating it?
I think Deepak's spot on in saying that inflation's entrenched and interest rates will move up, as indeed they will globally, but that interest rates are calibrated in an Indian context this time round. We won't see the double-digit sort of levels that we have seen in inflation or interest rates rising extraordinarily high. So I would agree with that. On the bonds, just an additional point to what Deepak said, and really, I think the ask is that we have a bond index, that we be part of a global bond index. And that is not off the charts at all. The finance ministry in its interaction today did say that they've held off because there was a bigger negotiation happening under BEPS. And once that is done, this is going to be one of the subjects in there, and it will come. And it is exactly this, where we become part of global indices. Deepak referred to global equity index, I think the global bond index. Our bond markets have really been the huge disappointment. For years, many of us have sort of worked away at trying to ensure that we had a vibrant debt market, a vibrant bond market. We have to take the pressure off our banks, where every project is funded by the banking system, and move that money from the banking system into vibrant debt markets. And we have had to control issuance of foreign debt historically because we don't like to see that coming into India. Our own debt markets have been so narrow and still very short term. You can barely raise 20-year debt in this market. And for infrastructure projects and for longer-term projects, that is the need. So focus on our debt markets, allowing foreign money to come in, I think is all going to be part of strengthening our system and strengthening the banking system, because it will enable money to move out of the banking system and the banks to then continue to lend to those that need it at an entry point. I think there. I had one additional point to make on, the first question that you've actually been focusing on, that you asked Deepak as well, which is to do with does this large capex capital spend budget of government, how does it translate to private investment being crowded in, which was one of the statements made. And I think what we haven't touched on enough, we talked about consumption and local demand, is exports. I think India can emerge as a big export hub if we are competitive. The tragedy has been that industry here has not always been competitive. Where it is competitive, IT services, etc., we have done brilliantly. But in terms of auto ancillaries, jewelry, we've got a few pockets of success. Infrastructure spend can help us be globally competitive. And I'll give you a lovely example where one of my customers in my HSBC days had, and he would export like $20 billion out of China into the Western markets. And he was also starting up in India. And he said that for a plant in India, which was actually producing quite close to Chennai, at 10% below the cost of a Northern China plant, and the Northern China plant was, dorms, traditional Chinese style, that even being close to a port and being in Chennai, we lost that 10% cost competitiveness because of the infrastructure and turnaround of getting the shipment out and away. And, that's because of finance costs and this quality of roads and ports. So if we can get this right, we might well find industries and manufacturing which are competitive for export, so that we are not just reliant on domestic consumption and demand, and we are able to push to be an export destination, which indeed is our hope. I mean, when we talk of China Plus One, the focus in PLI has basically been to feed the Indian market. But we have found as a result of it that we can export handsets, that we can export electronic products. I hope that we will be able to, for the 14 PLI schemes, export a lot of products, which we initially did with a view to replacing Chinese imports, but in fact we can become an export hub for those products.
Excellent point, Naina, and great pleasure talking to you today. Thank you very much for joining in with those insights. That's Naina Lal Kidwai, and from there we move to our next set of experts, Madhu Kela, to tell us why the stock market was happy today, though the bond market was not. And Sanjeev Bajaj, of course, in a minute as well, to give us a different perspective, as will be Hasib Drabu, noted economist, and Shamika Ravi as well. But Madhu, first take from you on why the stock market looked quite cheerful. Was it because there was no bad news, or was it celebrating the fact that the government chose to focus on capex and growth in a big way and not so much on populist welfare measures?
Yeah, Ujan, thanks for having me. Always pleasure interacting with you. I must say this is partially a combination of both of this. Essentially, first, there were no bad news. I don't think market was anyway expecting a bad news with LIC IPO ahead of us. I don't think people thought that there will be too much of bad news. And to give credit to the government, they have actually been quite consistent, at least over the last 2-3 years. The market got cheerful with a combination of 2-3 factors. Again, we went into the budget with not a very heavy positioning. If you see where Nifty was already down 10%, global markets are already corrected, and they have made some kind of maybe a short-term base. The Fed was out of our way. So obviously there was not a very heavy positioning. And plus, I would say the way the budget got presented today, there is at least I personally feel there is a lot of credibility to the numbers which they're talking about. We can now accuse them of being conservative rather than misleading the market, which maybe used to happen a couple of years ago, that you have an FCI, you have an HEI, you have all kinds of oil bonds, and you're still showing a fiscal deficit number which the market will get pleased with. But this time, I think there is a credibility number. And fourthly, I would say, is the capex which the government has committed, which I would feel that will fill up to a lot of sectors. And that gets coupled with the private sector capex. Obviously, you could see an upsurge in corporate earnings.
Right. What did you make of this 65,000 crore divestment target, Madhu? I mean, over the years, we've spoken so much about how much the government can achieve through asset monetization and disinvestment. Asset monetization did not get a mention in the budget, and disinvestment target looks like such a lackluster number. Is the government stepping back, you think? I mean, is it losing enthusiasm on the divestment project?
I don't think so. You know that I'm an optimistic person. But having said that, let us say they did in Air India, which would have been impossible to envisage that Air India can be privatized. If I talk to you 5 years back, you will say Madhu has gone mad. He is talking of unreal things, right? And they did, let's say, Neelanchal Ispat. I feel the earlier question which you're asking with them, because we also keep interacting with a lot of people. See, ultimately, it's a democratic setup to sell a BPCL. There are vested interests in the country. There are trade unions. There are people who will go and put a PIL in the court. So I think that it is a process. I don't think there is any doubt which we should have in the intent of the government, and also in the process. If the price is 400 rupees, if there are no buyers, if some strategic guy comes and he says that I want to buy BPCL at 425 rupees, I'm sure government have to think whether we can sell BPCL at this absurd value, because obviously they don't want this case to get opened after 10 years. So I think there is a clear intent, and that the government wants to do it. And I do believe that there is progress which is being made, whether it is in BML, whether it is in BPCL. We know that in the ground there is progress being made, but there is no certainty of the timeline. And having faced what they told last time with them, that we will do 1,75,000 crores, and you will end up doing maybe 30,000-45,000 crores. Then again, there is a whole question of credibility. So I think this being like a typically well-governed IT companies, that you under-promise and try to over-deliver rather than over-promising and under-deliver. So it looks that kind of a case to me. Personally,
okay,
if you ask
hold
me,
on, that thought, Madhu, I'm going to come back to you. Yes.
And just personally, if you ask me, will the government do more than 65,000 crores next year of disinvestment? I am pretty confident they will.
Okay, fingers crossed on that one. But Sanjeev Bajaj has been waiting by. Sanjeev, thanks for joining in. My first question to you is, of course, on consumption, because that a lot of people agree has got the short end of the shrift. You can argue that the government's focusing on prioritizing jobs, capex, infrastructure, and all these are good things. but maybe some thought and effort could have been spared also for welfare spending and income support at such a difficult year, which the government has been doing throughout the last 12 months. Do you think it's too early to exit that kind of time frame on revenue expenditure and move the whole focus to capex spending?
So then, we had also, one of our suggestions was to have a scheme for the urban poor as well, like Manrega for rural. So clearly that is not something that has been met. On the other hand, as we have seen in the last few quarters, we've had some months of very strong consumption as well. What it is showing us is that the resilience in the economy is very much there. Growth can come back as long as we see normalcy on the ground, normalcy from the pandemic and no supply chain disruptions. For example, even in Jan, with this third wave being handled quite well by the government, I know for multiple businesses, since you're not seeing shutdowns, people are going to work, they're being careful, but business is continuing. And Jan has not been a bad month either. So my guess is that the government, which has resisted on demand side stimulus or support other than for the lowest income in rural India, has in the last few years focused really on the supply side. Because, and especially even this time with the additional allocation for infrastructure, the message we are getting in is let's put in those building blocks. They may take some time, but that gives you more steady long-term growth. We must also keep in mind that we have to balance inflation. And while I hope this is a gradual look at interest rates between the RBI and the Finance Ministry, any significant amount of consumption-related support could have also had inflationary pressures. Now, what actually was in their minds, I don't know, but these can be the different reasons that come to my mind at least.
Sure. I'm going to go to Hasib Drabu in just a minute, but before that, Sanjeev, I mean, for a person who's trying to digitally reinvent his own company, what did you make of that announcement of the digital rupee? Do you think this year we could actually be doing transactions using digital rupees?
I don't know the timeline for that. RBI had also mentioned that they're working on a digital rupee. As you know, the government and the finance minister actually came out with a whole bunch of digital announcements. And to me, that is encouraging because it is showing that in this new era of digital, and we've been in it for 10 years, but we have multiple decades ahead, the government is not only willing, but is pushing all of us and coming forth themselves to start building the blocks of it, to sow the seeds across various digital areas. Coming to the currency, see, this is very interesting. As you know, cryptocurrencies are already there using blockchain, but who's there at the back? I mean, can we all blindly trust the blockchain formula, which one day shows the currency at $30,000 and the next day at $45,000? Here the government and RBI is doing something very interesting. They're saying that, okay, using the same blockchain, we'll give you our digital rupee, but we are there to back it up. And I think that in the near term is very significant. Now, there's a lot of writing on cryptocurrencies as well, that this could be the future, but it has to evolve. At least we will have in place an alternate. And as you know, currency is one of the strongest ways for a government to control itself. They won't let it go away easily to third-party currencies. So I think it's an interesting step. It's in the right direction. It doesn't mean that it's going to kill other currencies. Instead, I think the FM has clarified that they will treat other cryptos as assets. And that's a fair way to get started because there is going to be tremendous learning in this area in the coming years.
Terrific. Sanjeev, stay on. I'm going to get Hasib Drabu into the discussion now before we come back to you. But Madhu, you stay on as well. I've got one more question for you. Hasib, what did you make of the budget? Given the execution challenges that we've seen over the years, is it a fair bet that the government is taking that by prioritizing capex and jobs and deprioritizing, if I may use the word, consumption expenditure or welfare expenditure, do you think it can pull off a job-oriented kind of a growth platform over the next couple of years?
Well, then it's actually, if you look at it, it's a very pre-reform 80s kind of a good old budget, which is really talking about public investment driving the whole thing. It's an expansionary budget which is, in action, it's very, very expansionary, but it's distributive only in intent. So how it will pan out, we have seen that in the 80s, that growth doesn't happen with redistribution automatically. You do need public expenditure policy to cover up in terms of transfer payments, which we have been seeing. So there is an imponderable here. But honestly speaking, I would be a very worried man if I were the RBI governor today. Because the budget, you should reserve your judgment on the budget till the RBI comes out. Because two things have happened. You have now decisively expansionary fiscal policy with a threat of inflation. What will RBI do in its monetary policy? Will it be accommodative or will it be restrictive? Now that causes the old schizophrenia that we have had in 60s, an expansionary fiscal policy with a restrictive monetary policy. Second is to put up this whole currency market in a bit of a turmoil by saying that I'll get into digital currency, which again RBI has to manage. So I would honestly look at the implications of the budget post the RBI setup. But this is perhaps the first budget I recall where a number has been given about employment generation. I don't recollect a budget ever actually emphasizing a number, 6 lakh, 5 lakh, or whatever. But it doesn't really address the core issue to my mind. The core issue of the economy is the shrinking of the informal economy. Now, there were a variety of reasons why the informal economy shrunk, one of them being GST. Not in a negative sense, because GST was trying to formalize the economy and it cannibalized the informal sector, disrupted supply chain networks and so on and so forth. And it wasn't profitable for ancillarization and subcontract to happen because of the GST. Then the pandemic happens, which again hits the informal sector most. Now, the kind of infra spending that we are doing may generate jobs 2 to 3 years from now, but it will not be a replacement of the jobs in the informal sector. I would have seen some direct, apart from what you said in terms of public expenditure policy, but more in terms of trying to strengthen the reverse charge mechanism, for instance. Also, while there is no dispute on the extent of infrastructure spending, one is not sure about the quality of spending not in terms of executional, but purely where it gets into. I haven't seen anything, despite such a lot of noise about digitalization and all that, one hasn't seen a decisive push in infra towards data infrastructure, digital infrastructure, which will actually boost up the entire new economy setup. So one is concerned about that as a possibility, which will perhaps show up in the course of the next 6 to 7 months when things start picking up. You will hit those constraints. But today it is really a thing in terms of inflation being a big determinant and the loss of jobs that has happened because of pandemic. Right, while some of it has been replaced by the emphasis on startups, it's not quite the same.
We'll have to leave it there because we're completely out of time. Gentlemen, thank you very much all for joining in, and thank you very much for listening to us over the last couple of hours with our analysis of the fine print of this budget. More coverage continues on the other side of this break.